Hello, my name is Magnus Petersen. This talk is about share buyback valuation, and in particular, whether a share buyback is worth more than some alternative investment the company can make. I will assume that you have already watched the first video. So just to have a brief recap, the value without either a share buyback or the alternative investment is denoted V, and it is the excess cash that could be paid out as dividends now, plus the present value of future earnings that could be paid out as dividends. The value per share and after dividend tax is capital V. The value with a share buyback is transformed in two ways. First, we subtract from the value without a share buyback the buyback amount, and then we adjust for the decrease in the number of shares. So the value with a share buyback is denoted capital W. The value with an alternative investment is a value without a share buyback minus the investment amount plus the present value of the return on the investment. The per share value is divided by the number of shares, which doesn't change because there is no share buyback, and it also takes a dividend tax into account. It is denoted capital V subscript invest. The relative value of an investment and share buyback is found by taking the definitions of the value with the investment divided by the value with a share buyback. And assuming that the buyback amount equals the investment amount, the result is this formula here. The equilibrium can be written in different ways. We will write them as inequalities so we can see when the value to eternal shareholders increases from a share buyback. So the value with a share buyback is greater than the value with an investment when the market cap is less than this number over here. And this can be rewritten so that the condition for the value with a share buyback being greater than the value with an investment is instead expressed in terms of the return on the investment. So the return has to be smaller than this amount over here. This may look complicated, but it's a very powerful set of formulas when you learn to use them. So let's consider a case study with Hewlett-Packard. In 2010, Hewlett-Packard had net income of $8.8 billion and free cash flow of $8.4 billion. If we assume the earnings are constant forever at $8.6 billion, and this is the amount that can be paid out as dividends, we further assume that there's no excess cash and that the discount rate is 8.5%, then the value to HP's eternal shareholders is V, zero excess cash, plus earnings divided by the discount rate, $8.6 billion divided by 8.5%, which is about $101 billion. In 2010, HP's market cap was between $87 and $127 billion. HP made share buybacks for $11 billion. At the lowest market cap, the relative value of a share buyback would be as follows. So remember from the previous talk that this is a value with a share buyback, capital W, and divided by the value without a share buyback, capital V. This formula, and we just plug in the numbers, 11 billion for the buyback amount, 101 assumed to be the intrinsic value to eternal shareholders of HP, the buyback amount again, and the lowest market cap of $87 billion. So the result is 102%, which means that the value to HP's eternal shareholders would have increased about 2% from this share buyback under these assumptions. At the highest market cap for that year of $127 billion, the relative value of the share buyback would have been 97.5%, which means the value to eternal shareholders would have decreased about 2.5% from a share buyback. In 2011, HP acquired a company called Autonomy, and they paid $10.2 billion. So if we assume that HP's value to eternal shareholders is V, and it is still $101 billion, and HP's lowest market cap for that year was about $45 billion, then a share buyback for the $10.2 billion used for the acquisition would be more valuable than the acquisition when the following holds. So this is an equilibrium formula which is expressed regarding the return on the investment. It means that the value with the share buyback is greater than the value of the acquisition when the return on the acquisition is less than this amount, and we just plug in the numbers. Investment amount $10.2 billion, V assumed to be $101 billion, investment amount again, 10.2, 10.2, and the market cap, which was 45 billion at its lowest that year. And we calculate and find the result to be $27 billion. So it means that in order for a share buyback to be more valuable than the acquisition of autonomy, the return on the autonomy acquisition must be less than $27 billion. We can also use the equilibrium formula to value HP's restructuring, in which 29,000 people were fired in 2012 and beyond. This is called a restructuring, and the amount was $3.7 billion. It's not clear whether this was all cash and whether it was all spent in that year or spread over several years, but for simplicity, we will assume it was all cash and it was all spent in 2012. We will assume that the value V to eternal shareholders of HP is $60 billion because the free cash flow was only $6 billion and we use a 10% discount rate. You can try this formula with different assumptions so you get different numbers. At the lowest market cap for HP in that year, it was $27 billion, and a share buyback would be more valuable than the restructuring when the following holds. So it's the same formula we used before, and we just plug in the numbers. The investment amount, $3.7 billion, and V was assumed to be $60 billion, and the investment amount again and again, and market cap was $27 billion at its lowest. So this comes to $9 billion. So what it means is that if HP made a share buyback for $3.7 billion, then the value to eternal shareholders of HP would be greater than the value with the restructuring whenever the return on the restructuring is less than $9 billion. We can also calculate the relative value of HP's restructuring, and we could do the same for HP's acquisition of autonomy. So let's assume that the present value of the return on the restructuring is $7 billion. Then the relative value is calculated using the formula from one of the previous slides. So we have the return, $7 billion, the investment amount, $3.7 billion, market cap, $27 billion, value V, $60 billion, investment amount again, $3.7 billion, and this comes to 97%. So it means that the value with the restructuring is worth about 3% less than the value with a share buyback under these assumptions. If instead the present value of the restructuring return is $11 billion, then the relative value is 103.2%, which means that the restructuring would be worth about 3.2% more than a share buyback under these assumptions. So to summarize, share buybacks can be valued relative to alternative investments, such as acquisitions, restructurings, and so on. We can also assess the required return on the investment in order for the investment to be more valuable than a share buyback. You should note that the formulas are nonlinear and they may be counterintuitive, so you should study the papers well before you use the formulas. This talk was based on 2 papers. The first one is short and fairly easy to read if you are familiar with basic financial math. The second one is longer and much more detailed. They can both be found on this internet website, and the links are also provided in the description below the video.